I'm Doug McKenzie.
And I'm John Ward.
And we're the co-hosts of the ABCs of IBC podcast.
Come join us as we share our unique perspective on the infinite banking concept as the creator, Nelson Nash, intended.
Hi, Doug. Welcome back, everybody.
Hey, these weeks go by so fast, right? It's like, here we are again, for our audience, we've often done multiple episodes at one time and then, able to release them and not be together every week. But lately we've been together every week, and it does creep up on you like, okay, we gonna do another
Hey again, episode. John.
Yeah, here we are. And what are we going to talk about? So here we are. I get often asked for clarity, and it's almost like you have to slow down when you talk about some of this, right? Certain things I've gotten a little bit better at, like really trying to emphasize, break it down, right? Because I'll tell you, when I first heard PUA, or paid up additions, and it's a rider on the policy, it didn't make intuitive sense to me, the name, but it kind of does once you try to explain it. Do you want to explain it, or do you want me to, or do you want us both to give it a shot, or just see how it goes?
The paid up additions rider?
Yeah, the way I explain it, the way you explain it.
Sure. I mean, why don't I start off talking about just a really brief overview of a rider, okay, and then you can talk about the paid up additions rider.
Okay. Yeah, great.
Yeah. So I think that's a good reminder, because sometimes I even, we'll get into throwing around terms, and then I realize that people that might be listening for the first time might have no clue what we're talking about. And even in the beginning, I didn't know what any of that stuff meant either. So, so I think it'd be good to just do a little bit of an overview. So, a rider, so there's the base insurance contracts, and we're almost exclusively on this podcast talking about whole life insurance contracts. And so, a rider is part of the contract, but it's like an add-on. So it's a bolt-on add-on. And some of these riders that come on the contract have fees associated with them. Other ones are included and need to be utilized a certain way, but it's essentially not necessarily included with all insurance contracts across all companies. But this rider, the paid up additions rider, would be included on any contract that like John and I would provide to anybody. And it's really kind of what makes the infinite banking concept work. You could do this with a policy that did not have the paid up additions insurance rider, but this rider is generally included for most of the carriers that we work with. There tends to be some sort of charge for it, but there's not like an actual fee to have that included with the policy. And then John, I'll let you explain, why we utilize that and what it does to the policy.
Yeah. So, I mean, the original life insurance was whole life insurance, and they weren't so-called structured like the way we do them. They were just, I call them plain vanilla whole life. It had a face amount, and as long as you had paid the premiums that were due, you're always going to have the coverage, right? You're always, it's going to be what it is. Whole life also is some might know, but we'll clarify it, right? That it's, we write these policies with mutual life insurance companies, which means the policy owner is part owner of the insurance company, right? So they share in some of their profits, in essence, through, annual dividends, right? So one of the things that we're looking to do is to structure the policy so that you have more cash value earlier than you would if you just did the plain vanilla, right? Um, but we structure them so that there's some permanent insurance, which is the whole life insurance. And typically we add another rider, a term rider, so that we can put in the extra cash and not overpay for life insurance, meaning we can't stuff in this cash if they haven't met some guidelines that says you've got to have a certain amount of life insurance attached to those premiums. So you can't overfund one of these policies and really, evade taxes because of it. It is tax advantaged, but they have rules on how much we can put in, and we want to keep this an insurance policy, but we don't want it to turn into an investment, which makes it lose its tax advantages, and we refer to that as crossing the modified endowment contract line. So I've said a lot, probably confusing some people, but let's go back to, we want to have some of the cash value available today to start leveraging, doing whatever you want to do. And so we split it up between having permanent whole life and some of this term. That's your life insurance from the outset. But this paid up addition amount, which I also called optional, the optional amount you can put in every year, right? Though we structure it so you can put it in. So you should be trying to do that if we're going to structure it that way. So the paid up addition really goes almost straight to the cash value. A little bit of it doesn't, because it goes and buys what we call, this is where the acronym comes from, paid up additions. Paid means it's been paid up, it's done. The additions is that it buys micro amounts of life insurance. So every year that you're putting these PUAs or paid up additions in, it's actually buying a little bit of fully paid up life insurance, adding it to your death benefit. And a lot of that money that's paid for that PUA rider is going straight to cash value. And as we know from other episodes, it continues. So your cash value just continues to grow. Even when you borrow against the cash value, leverage that through a loan with the insurance company, your cash value continues to grow. So we have kind of the best of both worlds. We're getting permanent life insurance, as much of it as we can get, and get it to grow the cash value faster than it would if we just did a plain vanilla. Now, plain vanilla, if you don't need the cash, you're willing to let it just grow, it could slightly outperform the structured policy the way we do it with the infinite banking concept. But you didn't have the access to you didn't have access to as much cash. It takes a while. It takes 20 something years for you to start to get a pile of cash.
Yeah. I mean, any outperformance, if that occurred, would take many, many decades,
It takes like 40 years for you to.
Yeah. So, that's, we espouse thinking long-term, but that's thinking really long-term, for most people that want to be trying to utilize some of that now. So we try to find a good middle ground there. And yeah, I mean, even if you had a plain whole life insurance with no ability to pay premium towards a paid up additions rider, almost all whole life contracts now are structured so that even if you didn't have that, your dividends could buy paid up additional insurance. So in effect, you'd still have that rider on your policy. You just wouldn't have that flexibility in the premium payment, like
Yeah.
John talked about,
Yeah.
to
And
the optionality.
yeah. So to your point, the way that we also set these up is for the dividends to keep rolling into the cash value pile. And it is when we do that, it is buying, just like the paid up additions, it's buying micro amounts of insurance with that. And that's why, we keep growing the death benefit. And for those who don't know and those that do, just a reminder that in essence, the cash value is going to chase after that death benefit amount, because at age 121, they have to match. So if you're driving that death benefit to be bigger, right, through paid up additions, through your regular premium payments, in the natural growth, but also the dividends, then your cash value has to keep growing because it's got to catch up eventually. And so that's kind of the mechanics of it, and what the drivers are of trying to get you more cash value is because you're continuing to grow your death benefit, and so your cash value is working hard to catch up, and so that's a good thing, because what we're talking about here is financing the things in your life. We call it banking, but it's financing because we finance everything. And this gives you that money that you can tap into, or leverage again, and never touch yours. So yours never goes down, but you're going to finance things one way or the other through cash, credit cards, loans, what have you, right? But why not do it this way so that you keep the money flowing back to you every time you pay it down? And that's the essence of it all.
Mm-hmm. Yeah, and exactly. And it's funny that I've had people say, "Well, I don't care about the death benefit. I just want my cash value to be high." It's like, well, the way we get you more cash value is a bigger death benefit. They go hand in hand, and that's the only way that you can make room for the cash is by having the death benefit, because the cash is in fact a representation of what you have available now for the death benefit.
Yeah.
Took me a while to grasp that one. People view them as being separate when in fact they are one and the same. Um, but the paid up additions rider too adds another nice component to, because if you had a policy that was 100% base premium, you are contractually obligated to pay that full amount of premium every year. And so if you have an off year, or you maybe wanted to like make that up a little bit, you don't really have that flexibility. Whereas a policy, how we typically structure them, that rider gives the owner a certain amount of flexibility with paying premium. And so if, for example, you were required to pay, let's say, 40 to 50% of your total premium every year to keep the policy in force, the rest of that, if you were waiting on a bonus or you had some unexpected expense that came up, you do have some flexibility to wait on that. So, you could just not pay it. I wouldn't recommend that, especially in the earlier years, because you will limit yourself on how much you can pay on the paid up additions insurance rider later on. So, oftentimes, the insurance companies will stipulate that they will allow you to pay over the lifetime of the policy, whatever your average is for the first, is it 7 years, John?
Yep. 7 years. Yep.
7 years. So if you're missing out on that, you're kind of locking yourself into not being able to maximize that for the rest of the policy life. But they give you the flexibility to catch up, which is really nice. And so if it comes time for policy renewal and you're paying the premium, but you can't pay the paid up additions rider at that point, you have the flexibility to catch up for for a good amount of time and still catch up fully on that amount.
Yeah. Yeah. I'll use a rough example of working with a new client. So let's say they had the maximum they were going to be able to put in was 18,000. 9 was the minimum, which was the required amount. And so they started off the policy year because, okay, back to the fact that this is a rider, there is a fee. It's built into this, say, the optional 9,000. You got the required 9,000, you got the optional up to another 9. In that 9, the first year, there's $500 fee for this ability to put in the optional, right? So then so this person um, opted to just pay the minimum of the right away, right? Like, let's just pay the $500 that, let's just say, that was included in the minimum. And so let's pay 9,000. She went the whole year. It's a she. Goes the whole year, doesn't put in any of the 9,000 that was optional. The next year's policy premium becomes due. So the first thing is to go and, if you can, I talked with her about it. We talked about her finances. She puts in the optional 9,000 for the previous year, because that optional amount now becomes very close to, now she's got access to that 9. Let's say she's got access to 8 out of that 9, and maybe she had access to 2 out of the first required 9. So now she's got access to $10,000 to leverage. And that really didn't have to happen that way, because she does plan on, she's going to go and pay the next year's premium of 9 and then start to put it in, because she's going to free up some cash and she's just going to dump it in as throughout the year. But technically, she started, let's just say, January 1st with a new policy, had this 9 and 9, and she puts in the 9, doesn't put in the other 9. The whole year goes by. January 1st comes again. She decides, I'm just going to put the 9 in for the second year's premium. She puts the 9 in. She has not only the rest of the year to put the 9 in for the second year, she has all the way to the end of the second year to get that catch up from the first year's premium in. So she has another 18,000 she can put in, because she's only missed it 1 year so far, and she has all the way. So she technically had almost 24 months, less a day, right, to get that optional money in. And as Doug said, when we average the optional amount at its maximum, then we're in a position to be able to maximize that optional amount for the years going beyond that 7 years, so eight years and beyond. But if you only average 7, then year 8, you can only put 7 in, even though it was written for you to be able to do the 9. So it's there's just a little bit more flexibility, and sometimes that's just the way people have to do it. That's just the way, they want to get started, and they get started, and it, they start to really figure out all these mechanics with the help of Doug and I, or any other practitioner that understands this, right? And, you're going to get coaching the way you're going to get coaching for individual people. But, I enjoy personally, I enjoy helping people just keep figuring this out as they go. They got started. We didn't extend them so much that they weren't going to be able to do it. It's just, it's a rethinking of how you do things and what order you do them in. So hopefully that's helpful, but not confusing.
No, that was great. That was a really good example. Thank you.
Yeah, you're welcome.
Yeah, no, that was good. That sometimes I think it helps to walk through an example like that. So that was perfect.
Yeah, yeah. So there to me, there's maybe one other thing, Doug, that I'd share. And again, hope that I articulate it well, which is the way that we can do this. Let's say, because these policies, first you have to be healthy enough, you have to be in good health, standard, good, or better, and even substandard, you can get insurance too, but you've got to be insurable. But then there is limitations on how much you can put in as premium payments on an annualized basis based off of income or net worth. And typically we do it based off of income. And at different income levels, they will only allow your premium to be a certain percentage of that. And I'll use an example. Let's say you were making just, let's say you were making a penny less than 150,000. So you typically would only be able to put, say, 20% of that. And again, I'll round it for easy numbers. I'll say it is 150, but it's 1 penny short. So 20% of the 150 allows you to put 30,000 in. And so you'd think, well, I can't build this policy, even though I'm living on a lot less and I want to put 50,000 in, for example. You're telling me that I'm limited to this. Well, because of this ability to just pay the minimum on your PUA, just pay the first year, it's $500. Then the next following years are all, 120 a year or $10 a month. So you literally can structure the policy to look like, let's say it's a penny less than 30,000, again, the 20% of the 150, but it also gives you the room to put in another 20. But when they look at it from an underwriting standpoint, they're looking at what is required. And we can structure the policy to say the required is, 30,000. And that's what it looks like to any regulators. It just looks like a good way. Okay, they're only putting 30 in. You didn't go over this 20% of their 150, 149.99. They're not looking at, but you allow them to put another 20 in. But it's not funny business. This is the way
No.
this is the way it's structured. And you wouldn't do that unless you thought you were really going to be putting in most of that optional 20 to get to 50, right? Because then you're overpaying for this. But I just did that last night on a policy that they were applying for, because it fell where it needed to fall. But definitely this person wanted to put more money in. They wanted the ability to put more money in than, say, the 20% of their salary. And because we were able to show it, like, yeah, they're only committed to this amount. And that's what's required. And that'll give them the coverage, that'll give them, this whole banking system and the way we look at it. But that's not how regulators are looking at it, that might check on these insurance companies, make sure they're doing things right, that they're not overextending people, right? And, I talk through this with people so that, hey, why do we think you're going to be able to do it, right? And it's clearly something that they can do, because sometimes they've got, it's not just, even though we're basing it off their income, they have a spouse who has income, right? And, they only need half of their salary, and they need half of the take home pay, and they need half of the spouse, and they're fine, right? They're again, why they're even doing this is they're looking for a place to put their cash and not stick it in the bank and get nothing for it, and also leave it to whatever could happen. It's under their control a bit more, and they're not giving away the money. So yeah, that's it. I'm going to stop.
I got nothing to add to that, John.
I know, no, that's good. I think that means we've kind of hit the nail a bit and covered as much as we should, really, on this subject for now. And let's, we invite your questions. So, but I definitely know that this has been kind of a hump to get over mentally, intellectually, right? To understand what is this. And so the PUA, to me, I refer to it as optional, though we do want to try to make it happen.
I would never want to put a policy into force where I was including an amount of PUA that the person thought that they could not reasonably pay.
Right.
So
it wouldn't make sense, right?
No.
Because, Yep, because you've now made them have to structure it so that it looked like they were going to put that money in, which then required them to have a certain amount of insurance, which maybe wasn't even important to them. And now they have more insurance, and they can't even figure out how to get, this extra money in, right? Because, money's too tight. But again, that's a mind shift too, right? Is, oh, geez, I can't put in X amount of dollars, because again, they're looking at it like an expense. So we're just redirecting or helping them redirect their own thinking, to understand this isn't an expense. It's the building. I mean, I guess you could say it is, because it's building an asset, right? It's very similar to buying some other asset, but this asset's going to function differently in your life than maybe, things that we consider assets, all the things we own, houses, cars, and everything that we had to finance in our lives and fill our house with, and that kind of thing. But yeah, you definitely probably can put in more than you think you can, because it's not all going away from you. It's all going to serve you, right?
Yep. Yeah, if anybody has questions on this, I think we wanted to go over this again because we have gotten a lot of questions individually about this. Just let us know if anything's not clicking, and we'll happy to delve into it in more detail. So
awesome.
Well, thanks, John.
Yeah, thank you. Yeah, this is great. This was fun. And everybody, thanks for listening. Keep listening. We love sharing it. So, and thanks for all the great feedback that we've been receiving. It does make it worthwhile doing it every week if we know it's helpful in some small way.
Absolutely.
All right. Till next time.
Till next time.
All right. Bye for now.
Bye.
Thank you for joining us for another episode of the ABCs of IBC.
If you enjoyed listening, please hit subscribe and leave us a 5-star review wherever you listen. It really helps. See you next week.
Bye.